ZIM is a leader in the integrated shipping services space and is currently trading at a deep discount to their estimated fair value. They have multiple tailwinds, minimal risk, and an advantageous business model that should drive their share price higher over the next year. To better manage the fluctuations of the shipping business cycle, ZIM has adopted an asset-light model and charters individual ships for 1 to 5 years. This allows them to expand, contract, and adjust to demand and new regulations more efficiently than their peers. The flexibility of charters also allows ZIM to adjust their fleet to meet customers' changing demands. This has resulted in them growing from 87 to 149 vessels in 1.5 years and the recent leasing of more car carriers. In order to look into the future, we may have to look back into the past. We believe the shipping environment in 2023 will resemble more the pre-COVID period than it will resemble the 2020 to 2022 period. One educated guess would be that shipping rates continue their decline to pre-COVID levels, but do not dip below those. Port congestion, a big reason for the increase in shipping rates, is lowering while demand drops in a recessionary environment. At the same time, ZIM and other shippers have signed long-term contracts with clients over the past quarters. While these contracts are likely to be renegotiated given the huge drop in shipping rates, it is not unreasonable to expect ZIM to earn on average a higher rate than the spot rate in 2023. ZIM's 2023 revenue is expected to come in at around 85% higher than in 2019. This is a conservative estimate, which assumes that shipping rates have from their current levels and ZIM's long-term contracts will be significantly renegotiated downwards. We are also not taking ZIM's investments in technology and thus higher pricing power into account. We should also consider the fact that ZIM's chartering costs will also decrease in line with decline in shipping rates. Keeping all in view, we expect ZIM to post a revenue of $6.2 billion and EBIT of $400 million. We believe ZIM will remain profitable even when shipping rates are going to decline. ZIM recently announced that it entered into a 10-year marine liquefied natural gas sales and purchase agreement to supply 10 LNG-fueled vessels which will be transporting goods from China and South Korea to U.S. East Coast and the Caribbean in the 2023 to 2024 period. This deal with Shell is beneficial for ZIM and its investors, as this allows ZIM to increase the proportion of ZIM's future capacity that is powered by LNG. LNG is energy efficient, so the change in ZIM's capacity mix with a tilt towards LNG should lead to a reduction in fuel-related expenses and an improvement in the company's profitability in the future. The company has nearly $1 billion in cash. Counting its $2.5 billion in short-term investments, ZIM has more money in the bank than its market cap. And the company is still posting strong free cash flow each quarter. As a result, we can only conclude that shares are in fact available at steep discount. Most analysts are expecting a dividend per share of $4.83 for year 2023. At the current price of $25, ZIM is looking an attractive investment opportunity. Right now, the best strategy to go with ZIM is to sell put options with strike price $20 or below and expiry January 2023 or higher. This will give you a good premium and an opportunity to buy it below $20, which in the long run can translate into a 400% return with a target price of $80. Hence, ZIM is a strong case for value investors. The market is pricing in future deglobalization, monetary tightening of central banks, a severe recession in 2023, and huge increases in energy and commodity prices. The resulting strong US dollar leads to falling asset prices. A high beta sector such as container shipping has been hit hard by these factors, no matter what is the state of cash flow of individual companies. Hence, even if investors are staying on the sidelines, they should keep ZIM in their watch to buy in case of further price correction.